Hello traders, you're welcome to this video and I welcome you back to the Forex Geek channel. If you are looking for smarter ways to approach Forex trading, then you are in the right place. Alright, in this particular video, we are going to be diving deep into a method that is all about precision, adaptability, and staying in control. Okay, basically, we're going to be looking at the wobble trading technique. All right, it's the wobble technique trading method. So that's what we're going to be looking at in this video. So stick around because by the end of this video, you'll have a solid understanding of how to implement this strategy into your trading routine. All right. So what is the wobble technique? Right? The wobble trading technique. Wobble trading technique. Simply put, it's actually a trading approach that emphasizes managing positions dynamically instead of holding a single large position. All right. Now, the idea of the wobble trading technique is to break your trades into smaller, more manageable chunks. All right. It allows you to adjust and pivot as the market moves. So this method is excellent for controlling risk and capitalizing on small, consistent wins in volatile markets. Now, I'm just going to be starting with the basics of why the wobble technique works. Now, it's important to know that markets are constantly fluctuating. Of course, as a trader, you will know that the market is in a state of constant fluctuations, defined by all these zigzag movements that you can see on the charts. All right. And as it is usually said, price does not move in a straight line. All right. You always have your impulse moves and your corrective moves. Okay. For example, now this is a bullish trend, right? This is a bullish trend, marked by higher highs and higher lows. But you will not just find the price move in a very smooth, pace, or rather in a straight line from the low point to the high point without zigzags. You're not going to find that, right? You will always find up, down, up, down, up, down, what we call higher highs and higher lows. All right. And in the case of a sell trend, even when you find a steep slope, because in some cases you might find a steep slope, like a slope with, you know, um, uh, with crests and troughs that are not too far from each other, right? You might find, such slopes that the highs and lows, the zigzag movements are not so wide apart. But even amid such trends, you will notice that there are still zigzag movements. All right, as you can see, we are still having highs and lows even in this trend, even though the trend is quite steep. All right, up to this point before we now had, a more, significant difference. Right, we now had a more significant difference around here. So basically, what am I trying to explain? Right, the market is always fluctuating. Okay, so instead of locking yourself into a rigid strategy, the wobble technique lets you react to these movements in real time. So think of it as being flexible, like a tightrope walker who constantly adjusts their balance. Okay, so by doing this, you can avoid major losses while giving yourself more opportunities to catch some good moves in the market. So now here is how it works in practice. All right, it's how let me just quickly show you how it works. The first step is to break your trades into smaller lots. For example, assuming I want to enter a total lot size of, let's say, 0.1. Let's just assume I want to enter a mini lot size, right, of 0.1. So I can decide to break that lot size into five smaller, five smaller lots, right? So in that case, I'm going to be having 0.2, right? I'm going to be having 0.2 in five places, right? So if I'm to enter, let's say I have done my analysis, and let's just go quickly at the higher time frame. You can see that this is currently a buy trend, right? This is currently a buy trend. So having done my analysis, and I am looking for buy opportunities in the market, I want to enter with a lot size of 0.1. I can decide to break it down into five smaller lots, all right? And that five smaller lot is going to be 0.02 in five places, right? So considering the volatile nature of the market, the constant fluctuations and whatnot, I can decide to, set limits, right? So I already entered, based on market execution around here. I can set a buy limit around here. I can set another buy limit somewhere around here, right? Just in case if we have a pullback to the downside, right? And then I can set another limit around here. This is going to give us 1, 2, 3, 4. And then finally, I can set another limit around here. Now, you might be wondering, what if the market does not reverse? If it continues going up, if the bullish trend is strong? Now, if we have a strong bullish trend and it happens that the price continues to go up, I can just wait for a pullback. Remember that you have to identify the direction of the trend. Now, on the higher time frame, I have already identified this as a bullish trend. So I can just look for smaller bullish structures on lower time frames. I might want to look for other bullish structures on perhaps the 30 minutes time frame or the 1 hour time frame. When I say bullish structure, I mean I want to look for higher highs and higher lows on a smaller time frame. Then I can decide to set either I wait for the pullback to happen and I enter another buy position based on market execution, or after the price has gone up, I can set a limit, all right, at a potential reversal point. Or I can just decide to watch the market. As the price comes down, I can enter, and then when it goes up and it forms another higher low, I can enter again. And when it goes up and forms another higher low, I can enter again. So at the end of the day, once I have achieved my targeted lot size of 0.1, I can then stop opening further positions. All right, so basically, in that case, I have achieved breaking my trades into smaller lots. All right, now you have to watch the market carefully. Okay, you have to look for key support and resistance levels. All right, those are very important. Okay, those are very important. And then thirdly, you need to manage your risk. Okay, you have to set clear stop losses and profit targets for each trade. For example, if I was going to have all these trades executed eventually, I can decide to set my stop loss below this significant swing low, right? Below this significant swing low. And then for my take profit, since I am using higher time frames, to determine my entries, I can decide to target a significant resistance zone on the higher time frame where I initially did my analysis. All right. And then finally, you need to stay adaptable. Okay, if the market moves against you, you can close parts of your position to minimize losses and reposition yourself as the market reverses. All right. Now let us talk about the benefits. Okay, let's quickly talk about the benefits. First, this method, the Wobble trading technique, it reduces emotional trading. Okay, since you are breaking up your trades, all right, as you can see here, you won't feel the pressure of having all your capital tied up in one position. Okay, second, it helps with risk management. Smaller trades mean smaller potential losses, giving you more breathing room to make calculated adjustments. All right, now here are some quick tips to help you master the Wobble technique. Okay, always plan your trades before you start. It is very important. All right, know your entry and your exit points. Okay, calculate your entry points. All right, before you go ahead to enter. All right, you can use reversal points, points of pullbacks, the closure of pullbacks. For example, in a buy trend, you can be targeting, swing lows for your entries. All right. So you have to calculate ahead of time. Know your entry and exit points. Use technical analysis tools. Make use of trend lines. All right. Very important. You have to make use of trend lines. All right. You can also make use of Fibonacci levels. You can also add technical indicators like moving averages, just to identify key zones. All right. And then you monitor your trades effectively. Monitor your trades actively. This isn't a set it and forget it method. All right. And then it's also important to practice on demo account before using real capital to refine your skills. Okay. So one thing to keep in mind, the wobble technique requires patience and discipline. All right. It's not about chasing the market, but about strategically positioning yourself to respond to its movements. Now, like any strategy, it is not foolproof. Okay. But with practice, it can become a good addition to your trading toolkit. So that is it for this video. I hope this gave you a clear understanding of the Wobble technique trading method and how it can help you trade smarter, not harder. Okay, if you found this video helpful, do me a favor, hit that like button and subscribe to the channel, and don't forget to ring the notification bell so you never miss out on future content. Let me know in the comments if you've tried the Wobble technique or if you have any questions. I would love to hear your thoughts and experiences. Thank you for watching, and I will see you in the next video.